Welcome to the Deep Dive.
Great to be here.
Today, we're strapping in for a really interesting exploration of Rocket Lab Corporation's Q2 2025 earnings. You've handed us a fantastic structured analysis, breaking down their performance into 5 key areas. We're going to use this as our map today.
Right, try and make sense of it all.
Exactly. Our mission is to decode the strategic choices behind the headlines. How does a growth company like Rocket Lab balance that impressive revenue growth with, well, pretty significant long-term investments?
It's a real balancing act, like you said.
This deep dive is all about understanding that delicate orbital balancing act. Okay, let's unpack this. Now for slide 1, the at-a-glance scorecard.
Okay.
So let's kick things off with the headline numbers. What was the initial verdict on Rocket Lab's Q2 performance, especially looking at revenue and earnings per share?
Yeah, it's fascinating because you immediately see 2 different stories here. So Rocket Lab reported total revenue of nearly $145 million. That's a strong beat against the Wall Street estimates, which were around $135 million.
Okay, so better than expected on the top line.
Right, and that's solid growth too, over 36% compared to the same quarter last year.
Pretty robust.
Very robust. But then you look at profitability. They reported a diluted loss per share of 13 cents. That was actually a miss compared to the consensus estimate, which was looking for a 10-cent loss.
Oh, okay. So wider loss than anticipated.
Exactly. And that loss widened quite a bit from last year, too, over 60% bigger.
Wow. Okay, that's the classic scenario, isn't it? Strong revenue, but the loss gets bigger. For someone trying to understand what this really means, for a company like Rocket Lab, could you quickly clarify diluted EPS? And maybe more importantly, why did this gap happen? Why the beat on revenue but miss on earnings?
Yeah, good question. So diluted EPS first. It's basically a more conservative way of looking at profit per share. It takes into account all the things that could potentially dilute their earnings in the future, like stock options, convertible debt. It assumes they've already been converted into shares.
Right, so it gives a fuller picture, especially for growth companies using stock compensation.
Exactly. It's comprehensive. Now, why the gap? The main reason for that bigger net loss was a really significant jump in operating expenses.
The spending side.
Precisely. They shot up over 50% compared to last year, hitting around $106 million. That growth in spending just outpaced the 36% revenue growth.
So that's what you call negative operating leverage.
That's it. For every new dollar of revenue they brought in, they actually spent more than $1 in additional costs during the quarter.
Like that restaurant analogy we discussed, getting busier, but kitchen costs are rising even faster.
Perfect analogy. Yeah, you nailed it. There was also a small secondary factor, a slight increase in the number of shares outstanding.
Okay.
So you're spreading a larger loss over slightly more shares. But the big story is the spending.
And this reflects that tension, right? The market loves the growth story, especially Neutron. But the very spending needed for Neutron is what's hitting the current earnings per share.
Absolutely. The investments causing the EPS miss are the exact same things fueling the market's optimism. It's a clear strategic choice. Invest heavily now for the future, even if it hurts profits today. That's the tightrope.
Moving to slide 2, the engine of profitability.
Right.
All right, so knowing that, let's zoom in a bit. How is Rocket Lab managing its operational efficiency? Let's dig into the engine of profitability, their margins. How are they doing there while pouring all this money into these huge projects?
Okay, so to really get this, we need to quickly touch on GAAP versus non-GAAP figures.
Ah, yes, the accounting fun.
Indeed. So GAAP generally accepted accounting principles. It's the standard regulated way companies report, very consistent.
Got it.
Non-GAAP is where management makes adjustments. They pull out certain items, maybe stock-based compensation, maybe one-off costs like acquisition expenses, to show what they think is a clearer picture of core operations.
And for you, the listener, it's important to know what's being pulled out right.
Crucial. Non-GAAP can show trends, but GAAP shows the full cost, including things that, well, sometimes keep happening in fast-growing companies. Always look at both.
Okay, so with that in mind, what do Rocket Lab's margins look like?
Well, it's really a tale of 2 margins here. Their GAAP gross margin, that's revenue minus the direct cost of producing their goods and services, it actually expanded impressively.
Oh, good news.
Yeah, really good news on that front. Up 650 basis points, or 6.5% compared to last year. Hit over 32% in Q2.
Okay, so they are getting more efficient at the actual delivery part.
Absolutely. Gross profit jumped significantly from about $27 million last year to over $46 million this quarter. Much better efficiency there.
But There's always a but, isn't there?
There often is.
Yeah.
That efficiency didn't make it down to the bottom line. Their GAAP operating loss actually got wider. It went from about $43 million last year to almost $60 million this quarter.
Wow, that's quite a disconnect. Making stuff more efficiently, but losing more money overall. What explains that gap? Sounds like that investment appetite we talked about.
That's exactly it. The reason is purely in the operating expenses below the gross profit line.
Okay.
While gross profit improved by a healthy $19 million, total operating expenses surged by over $35 million.
Oof. Where did that primarily go?
Overwhelmingly, it was research and development, R&D. That jumped a massive 65%, hitting over $66 million.
$66 million on R&D alone. Mostly Neutron, presumably.
You'd have to assume Neutron is the lion's share, yes.
Mm-hmm.
And then selling, general, and admin costs, SG&A, they also rose about 30%.
So basically every dollar they save from being more efficient in operations plus more on top got plowed straight back into R&D and scaling up.
Precisely. Developing future tech, building the corporate infrastructure, and even if you look at their non-GAAP numbers, which back out things like stock compensation and about $5 million in transaction costs.
Probably from that Geost acquisition.
Likely, yeah. Even with those adjustments, the non-GAAP operating loss was still wider than last year.
So whichever way you slice it, strategic investment is the story, outpacing current profits.
It reinforces that narrative completely. It's a deliberate choice.
Moving to slide 3, the engine room business segment performance.
Okay.
That paints a clear picture of the spending priorities. Now, to really understand that impressive top-line revenue growth, we need to look under the hood, right?
Yep.
Into the engine room, Rocket Lab's individual business segments. What drove the growth there? Were both engines firing?
Yeah, good place to look. They report in two main buckets. Service revenues, which is mostly the Electron rocket launches.
The flagship service.
Right. And then product revenues. That's
Yeah.
their space systems, division-making satellites, components, software, that kind of thing.
Okay, and how did they perform?
Well, Q2 showed a really interesting kind of shifting dynamic. Space systems is still the bigger part of the business by revenue. It brought in about $93 million.
Still the workhorse.
Definitely. And it grew at a solid 28% year over year. But
Yeah.
the real engine of growth acceleration this quarter was the service segment, the launches.
Ah, how did they do?
They surged, up an impressive 52% compared to last year, hitting almost $52 million.
Wow, over 50% growth in launch services. That's significant.
It really is. And it lines up perfectly with what CEO Peter Beck said. He credited strong operational performance, a rising launch cadence, and more international demand for Electron.
How many launches did they do?
5 Electron missions in the quarter, which is a pretty good clip for them.
Yeah, that helps explain the revenue jump. What about profitability of these segments?
So the product segment, space systems, that's still the financial bedrock. It generated $31 million in gross profit with a healthy 33% gross margin.
Okay, stable and profitable.
Exactly. But the service segment, launch, it showed dramatic improvement too. Its gross profit grew over 73% year over year, so becoming more profitable as well.
So it sounds like space systems is the reliable foundation providing cash, while Electron launches are really hitting the accelerator pedal right now, driving that headline growth.
That's a great way to put it. You're seeing a really well-balanced strategy. The profitable space systems side gives them stability and cash flow to fund the big bets.
Like Neutron.
Exactly. While the high-profile launch business, especially with Electron ramping up, acts as the key growth driver right now, pushing those record revenues, it's synergistic.
Moving to slide 4, financial strength and shareholder rewards.
Right.
Okay, investing this heavily, especially in rockets, which, let's face it, aren't cheap. It requires a really solid financial foundation.
Absolutely critical.
So how is Rocket Lab funding this aggressive expansion? What does the balance sheet tell us about their priorities? Are they rewarding shareholders now or just fueling the growth engine?
Yeah, for a growth company like this, looking at liquidity and debt is paramount. Analysts often use the debt-to-equity ratio.
How does Rocket Lab look there?
Theirs is about 1.26 as of the end of June. That indicates, a moderately leveraged balance sheet.
Which isn't unusual for companies in this heavy investment phase.
Not at all. It's quite common, often necessary. A big chunk of their liabilities, for example, is over $376 million in convertible senior notes.
That's debt that could turn into stock later.
Potentially, yes. But despite that leverage, they do maintain a strong cash position. They had over $564 million in cash and cash equivalents at the end of the quarter.
Okay, so they have a cushion.
A decent cushion, yeah. Now, if you connect this to how they're allocating capital, the cash flow statement tells a very clear story. raise money to fund growth.
What do you mean?
Well, in the first half of 2025, they didn't pay any dividends. They didn't buy back any shares.
So no direct returns to shareholders that way.
Nope. All the focus in their financing activities was on bringing cash into the company.
How did they do that?
Primarily, nearly $400 million came from what's called an at-the-market or ATM equity offering.
Selling new shares directly into the market.
Exactly. Which, does dilute existing shareholders. Their slice of the pie gets a bit smaller.
Right.
And they also took on another $25 million from a secured term loan. So it's classic high-growth, high-risk behavior.
Aggressively raising capital.
Absolutely. Success here really hinges entirely on whether they can deploy all this capital effectively into projects like Neutron that generate massive future returns. It's a big bet on their own future execution.
Moving to slide 5. The road ahead management's outlook and key takeaways.
Okay, the final piece.
We've looked at the past, the present financial situation. Now let's gaze into the crystal ball, or at least management's guidance. What's Rocket Lab's outlook? And maybe most importantly, what are the key takeaways from this whole deep dive for you, the listener?
Well, the guidance they gave for Q3, the next quarter, was positive. It signals that the momentum is continuing.
Good sign. What are the numbers?
They're expecting revenue between $145 million and $155 million. At the midpoint, that would be another record quarter for them.
Okay, continued growth. What about margins?
Also looking up, they expect GAAP gross margins to keep improving, forecasting between 35% and 37%. That's up from the 32% we just saw in Q2.
So, continued efficiency gains expected too.
Yes. And CEO Peter Beck sounded pretty confident. He said, and I'm quoting here, "We're confident our strategic investments will drive new growth opportunities that will drive us toward long-term profitability."
Strong statement. Did he say anything specific about Neutron?
He did give a crucial update. He noted, "We've also made steady progress with our reusable medium-lift rocket Neutron, and importantly, with Launch Complex 3 now largely complete in flight hardware on its way there for first launch."
Okay, tangible progress being reported. That sounds key.
Very key, given market focus.
Here's where it gets really interesting. We've covered a ton of ground. For the listener trying to boil this all down, what are the absolute biggest takeaways from Rocket Lab's Q2? What should they really focus on?
Okay, I think there are 4 main things. First, that headline story. Strong revenue, strategic loss.
The beat and miss.
Exactly. It perfectly sums up the strategy. Leveraging that accelerating launch growth, remember, up 52% to deliberately fund that 50% surge in operating expenses, mostly for Neutron R&D. It's a conscious choice to invest via the income statement.
Okay, takeaway 1. Deliberate investment strategy.
Second, core business efficiency is improving dramatically. Don't overlook that 650 basis point jump in GAAP gross margin. That's a real positive, showing their established business is getting more profitable, which helps fund everything else.
Right. Takeaway 2. Core is getting stronger.
Third, guidance signals continued momentum and confidence. The Q3 forecasts for record revenue and higher gross margins show management feels good about the core business trajectory.
Okay, confidence from the top. And the 4th.
Finally, and maybe most importantly right now, the narrative is now all about Neutron execution.
Ah, the big one.
Yeah. After the stock ran up quite a bit before earnings, pricing in a lot of future success, the whole investment thesis really hangs on getting Neutron right and on time.
And some analysts are saying it's priced for perfection.
Exactly. So that confident commentary from the CEO about progress, absolutely critical. Any hint of delays could really hit the stock's valuation hard. It's high stakes.
Makes sense.
And maybe a final meta point. Using a consistent framework like this to analyze earnings helps you get past the headlines.
Right.
You can see the underlying drivers, check the financial health, understand the outlook. It's a repeatable process for really understanding your investments over time.
So what does this all mean for you? Rocket Lab's Q2 performance is, well, it's a textbook example of a growth company making a really bold strategic bet. They're clearly sacrificing today's bottom line profit for what they hope is a much, much bigger long-term prize with the Neutron rocket.
That's the goal.
The crucial question now becomes, can they execute flawlessly on this massive, highly anticipated project, especially when market expectations are already, frankly, sky high? That's the tightrope they're walking.
Very fine tightrope.
We really hope this deep dive helped you understand the nuances behind those headline numbers. The ultimate test, really, for companies like Rocket Lab isn't just raising money or having some early wins.
Right.
It's successfully turning those huge R&D investments into products that scale and make profit. especially when the market already expects perfection. Makes you think, what other companies are currently walking this kind of tightrope, sacrificing today for tomorrow's potential?
Good question to ponder.
Disclaimers. Please remember, this report is for informational purposes only and does not constitute financial, investment, legal, or tax advice.
All investment decisions should be made based on your own research and in consultation with a qualified financial professional.
While efforts have been made to ensure accuracy, no guarantee is provided. This report was generated by an artificial intelligence model, integrating data from the company's official earnings press release with publicly available market data.
All information should be independently verified by the user.
Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.